eXoZymes, ticker EXOZ, had no official Wall Street consensus to beat or miss this quarter. So here are the hard numbers they just reported. $0 in revenue, a GAAP EPS of -33 cents, and, well, guidance that their $5.65 million cash balance will only fund operations through the end of 2026. As for the stock reaction, shares popped 10% to $7.04 in the regular session, but they dropped 7.5% after hours. We are pulling from their latest earnings release, SEC filings, and management commentary today, and our mission for this deep dive is to figure out if this company is on the verge of a biomanufacturing revolution or if they are just incinerating shareholder capital.
Right. And I mean, that negative EPS is driven pretty much entirely by their cash burn.
Yeah.
During the first half of the year, their research and development spending surged over 85% year over year.
Wow.
Yeah, hitting like $2.56 million.
Okay, let's unpack this, because for a pre-revenue company, that is a staggering acceleration in spending. I mean, it's like they are upgrading from a hand crank to a fully automated factory line, but the factory is running out of oxygen.
That is a great analogy.
So is this level of pre-revenue burn actually justified by any tangible technical progress?
Well, what's fascinating here is that management claims this capital actually delivered a massive operational breakthrough.
Okay.
That R&D spend was heavily targeted at their lead program, a synthetic biochemical compound known as NCT. Now, to understand why this matters, we have to look at how they are producing it.
Right. They're using cell-free, AI-engineered biomanufacturing, which, sounds like an intense buzzword salad.
Sounds like it does.
But the mechanics behind it are actually brilliant. Traditional biomanufacturing uses living cells like yeast or bacteria to produce biochemicals.
Right, and living cells are inherently selfish.
Yes.
They consume a massive amount of the nutrients just to keep themselves alive and reproduce, which just wastes time and energy. So eXoZymes strips away the living cell entirely. They extract only the specific enzymes, the biological machinery that actually does the work, and they run the chemical reactions in a nutrient broth without all that cellular baggage.
And then they use AI models to instantly find the absolute perfect temperature, pH, and enzyme ratios for the reaction.
Precisely. And that is how this recent R&D spend resulted in a 10-fold productivity increase for NCT.
Tenfold.
Wow. Yeah. Because they aren't keeping cells alive, their optimized process now yields 67% more product per liter, and it cuts the actual reaction time by over 80%. So they are proving the science actually scales.
I'll admit, getting 67% more yield in a fraction of the time is impressive. But I have to push back here. Proving the science works in a controlled environment doesn't automatically mean the business scales.
That's very true.
To actually monetize this cell-free technology, they would need massive production facilities, which they clearly cannot afford right now. So how exactly are they planning to get this to market?
So management is trying to sidestep the infrastructure costs with an asset-light strategy. They aren't building the factories themselves.
Okay.
Their timeline is to secure a contract manufacturing partner by the end of Q3 2026.
Right.
And once that capacity is locked in, they aim to sign a commercial launch partner by Q4 2026. If they execute that, it sets them up for a product launch in the first half of 2027.
Letting their partners carry the heavy financial load.
Exactly.
So what does this all mean for you, the retail investor holding the stock right now? Because aiming for a mid-2027 product launch requires flawless execution.
Right.
But their own guidance says the cash completely runs dry at the end of 2026. I mean, the math just doesn't add up.
If we connect this to the bigger picture, that math is exactly why the stock dropped after hours. The primary risk here is an acute liquidity crisis.
Yeah.
The company officially issued a going concern warning in their filings, basically signaling they might not survive the year.
Which is a huge red flag.
It is. It's true. They recently brought in a $5.9 million equity raise, and they just secured a $2 million NIH grant for a separate cannabinoid program.
Right, but those are just temporary lifelines.
Exactly.
Yeah.
If management doesn't secure upfront partner cash by December 31st, investors are staring down the barrel of severe dilution.
Meaning the company will have to issue a mountain of new shares just to keep the lights on.
Yeah, completely crushing the value of existing shares.
It is the ultimate biotech paradox for you to mull over.
Yeah.
You really have to evaluate whether the massive total addressable market for ultra-efficient, cell-free, AI-engineered biomanufacturing is worth betting on a balance sheet that currently offers zero margin of safety.
It really is a high-stakes race against the calendar.
Make sure you follow the show for our daily earnings coverage so you never miss a beat on where the market is moving.